Hey folks, welcome to the Rate Update with Dan Frio. I am Dan Frio. Today is December 14th, 2021. When you come back, we're going to talk about the Federal Reserve. They're meeting as we speak and what we expect from that meeting and how the markets are reacting. So don't go away. We're going to talk about that next. Well, for those that watch my channel, you know that we talk about the Federal Reserve because we're trying to debunk a lot of things that the people think the Federal Reserve is in control of. One thing is mortgage rates, which they are not. So one of the mandates the Federal Reserve has is inflation or keeping it in line, and the other one is the jobs report. Well, we're seeing that inflation is going bonkers right now. So what we're going to do is we're going to see what happened with the PPI. That's the producer price index, and that's the one number that the Federal Reserve monitors closely. And I think it's going to be bad news for those still looking for lower mortgage rates. So listen to Rick Santelli, and when we come back, I'm going to dissect those numbers and tell you how the markets are reacting next. So take it away, Rick.
Yes, our November read on producer price index up 0.8%, up 0.8%. That's hotter than expected. And if you remove food, energy, and trade, it is up 0.7, also hotter than expected. And if you just remove food and energy, it's up 0.7. So food and energy, 0.7, food, energy, and trade up 0.7. Now, the year-over-year numbers up 9.6 on headline producer price index. That is a new record. And if we look at food and energy year over year, up 7.7, also a new record. And remember, these go back to 2010 on the year over year because they recalculate a little differently. So that's the most recent comp. And if we look at year over year, food, energy, and trade, up 6.9%, another record. So all the numbers are hotter than expected, and of course, we should expect this to happen. We know transitory's been retired. We knew the consumer price index that we had last week was hot as well, but yet we continue to see the long duration, the long maturities, 10s, 20s, 30-year on the Treasury side. Well, the rates aren't as responsive as one would think. They're highly in negative territory in terms of inflation, but we do see the yield curve remaining very flat. We see the shorter maturities very responsive this week because we have the Fed meeting, and most likely the taper is going to be quickened and rates will rise quicker, and I think that's why the curve has been acting the way it has. Joe, back to you.
So as you can see by the data Rick Santelli just presented, the Fed's going to move, guys. They're going to move. Okay, so it's time to jump off the fence. But it's not time to jump out the window, because even if rates go up to 4.5, I don't know if you paid attention to one of the things that they talked about was back in the 80s, rates were about 13.99. Okay, so if rates went back to there, would there be a housing crash? You betcha. Maybe, because you got to live somewhere. I'm going to leave it at that, because we come back later this afternoon. I'm going to talk about rents, how rents are getting crazy. And but I just want to make this well aware. Guys, you don't have to buy a house. Okay, so just, you got to live somewhere. You can buy or rent. I'm just giving you my opinions on how I look at things and maybe the financial benefits behind all of it. But I think you're going to find tonight's video in regards to the rental market very useful. So now, without further ado, why did you come to my channel? Well, you come here because you want to see what's going on with mortgage rates. So let's post where rates started today, and then I'm going to give you the effects on where, once this news came out, or some news came out this morning about the PPI, how that affected the markets since the opening bell. But we open up here, and this is where rates are. These are not my rates. These are the national averages. So if your rates that you got quoted is much higher than this, please reach out to us. If they're much lower than this, please reach out to this. One way or another, we just want to make sure you're getting the right program, the best rate, and the lowest fee structure in the industry. So right now, here's what we're going to look at. We're going to look at where the rates are right now. Okay, so we got this. Let's look at the top here. We got a 30-year fixed rate, 3.17. Yesterday was 3.2. The difference between the 2 days is down 3.03. We reference that as basis points, so it's down 3 basis points. Okay, the 15 year is 2.52. It is down 2 basis points from Monday. The FHA is 2.85, down 3 basis points. Jumbo is 3.09, down 3 basis points as well. Nice little pattern right there. And then we have the 5-year ARM. It is down to 3.25, down 15 basis points. Reason being is that those are locked in a different maturity, bond maturity, and that's why rates fluctuate much more than the 30 years do. Okay, so that's that. So what's going on with the MBS market right now? Let's look at that. People follow me because of this chart right here. They're like, Dan, what's going to go on with what's happening with rates? Where do you see them going? Well, we follow this market right here. This is the MBS market that's on Wall Street. It's called the mortgage-backed security market. It is a bond that trades on Wall Street. I'm going to leave it at that. It's a bond that actually determines your mortgage rate in its simplest terms. Bonds 101, when the price goes down, as you see here, what happens with mortgage rates? Well, they go up. Okay, so if the price goes down, if there's an inverse relationship with the maturity or the yields, in this case, because it's a bond of mortgages, that means mortgage rates go up. Okay, so let's get on to where the charts look like, and I'm going to show you the chart over the last quarter. Pretty big variance. I mean, look across here. We're at a 104. You can look at the top right, 104, and then this is down all the way to 101 point, let's say 7. That's a huge move, guys. Okay, so what we're trying to focus in on is right here. The tough thing about doing all this stuff is really the markets anymore, they're not trading on fundamentals. They're basically trading on what the Fed is doing and what the Fed is doing. So why? Well, if the Omicron virus hits harder than they think, well, the Fed's probably going to halt doing a lot of this stuff. We don't see that in today's meeting. We see that they're going, and even Rick Santelli said they're going to move. They're going to move. They're going to taper, probably taper big and fast. Okay, so that's what we're going to focus in. That's the main issue right now. So I'm monitoring this on a tick-by-tick basis. I'm doing all this work for you. I can almost guarantee you your mortgage company or your loan advisor is not doing this for you. And if they're not, they're doing a disservice. Okay, so that's why you pay fees to get a mortgage. Okay, so the next thing is, what is the economic calendar for today? Well, the biggest news that we're seeing is producer price indexes. Okay, this is the inflation number that the Federal Reserve watches. They have two mandates in their entity, and why they were created is job full employment. Okay, that's the job numbers that we're going to see later in the week, and price stability, and that is inflation. Well, they monitor closely what's going on with the PPI. We just had a PPI number that we've never seen before. So when it's that hot, the Fed's going to say, okay, we need to do something. We need to do it now. Later this week, we're going to start seeing, where did it go? Okay, the federal rate decision is coming in tomorrow. So we'll know tomorrow around 1 o'clock what they actually decided. And at that point, I can guarantee you the markets are going to either correct, they're going to rally or crash. Okay, they're probably not going to be just They're probably going to move in a pretty big way, one way or the other. Then on Thursday, we have the continued jobless claims and initial jobless claims. Well, this is coming out after the Fed's decision, so that'll be kind of a moot point on Thursday. We're going to focus mainly right here. And then once Federal Chairman Powell, he runs the Federal Reserve, once he sits down and speaks with Congress, it's all gloves off, because they dissect every word he says. Intraday, what do we see going on intraday? Let's look at this chart, the whole day. Let's see, whole day. Why can I not get there? Hold on 1 second. Look at this chart, guys. Okay, this is nuts. We came out of the gate and just crashed. The good thing is we've had a nice rally back. So you can see now we're only down 5. I can't imagine how far we were down at this point. So I like the trend that we're going on right now. So you watch my videos. I greatly appreciate that. But how do you reach out to us for some assistance? Well, let me ask you this. Are you looking to build a house? Can your lender give you a 6-month rate lock? Rates are going to probably be higher at that point. I don't have a crystal ball, but I have Rick Santelli and the Fed basically telling us they're going to taper. Tapering means rates are going up. Okay, that's one. So, are they giving you a lender credit? I had a video last week that I put in there and says, is the lender credit always worth it? I had a client that was getting a $7,000 credit from their builder, and the lender builder's choice was charging them $7,000 in fees and points. They didn't need to, because my rate was already better than what they had. And that's what happened there. So sometimes the credits you're getting from your builder doesn't actually pan out. So if you're looking to buy a house, you want to get pre-approved. You don't want to get pre-qualified, because a pre-approval is more solid and gives you a better chance with your offer than a pre-qualification. If you don't know the difference, reach out to us. How do you do that? Well, the easiest way to do that is give us a call, 844-775-5626. Make sure you call that number, because if you don't, you might get another company. The next thing is, how else can you get us? We try to call, but Dan, I'm in California and I get off at 10 o'clock. By that time, you guys are gone. What do I do? Well, you do this. Schedule a meeting. And what you'll do is you'll get paired up with me or one of my mortgage advisors. You'll jump in there. You'll pick the day and time of your choice, and then you're going to let us know, do you want to do it by phone or Zoom? I love doing by Zoom, because then we can see you, we can go over some of your materials and so forth, but that's completely up to you. Or if you're like, Dan, I just want to get the ball rolling. How do you do that? It's as simple as just click the Apply Now button. We do have one more service. If you're in the mortgage process right now, your mortgage company, once you apply, within 3 days of pulling your credit, they have to send you what we call a loan estimate. Okay, a loan estimate. That goes over where every penny of that loan is going to. It gives me the value of your home, the loan amount, your interest rate, all lender fees, title fees, and the whole ball of wax. I'm going to review that for you and see if I can scan over 180 lenders throughout the country to get you better terms, or maybe even get you into a better program. How do you find out, or how do you get your information to me to review? We have a brand new email. It's LE for loan estimate. So LE review, singular, LE review at therateupdate.com. Can't make it any more simpler. Tonight, we're going to go over a video going over the rental market and how much of a nightmare it is. And I'm going to show you actually areas why it's getting where it is, and is at where it is, why they're expecting rents to even go higher and home prices. But I got a little bit of light at the end of the tunnel to share with you later this afternoon on that. So don't go away. So like always, if you would, please give me a thumbs up, subscribe down below, hit the bell every time I post a video, you get an alert. I'll see you later this afternoon, guys. Thanks for watching.